Woohoo! I really triggered people with my take on Paul Merriman. This is fun. So about a year or so ago, about a year and a month ago, I did a video that how does Paul Merriman keep getting this wrong? And I did a video 2 months previous to that on Paul Merriman's talking about how this portfolio could beat the S&P 500 by 300% or something like that. I can't remember, but it was just silly, and it's not. All right. Anyway, so that really triggered some people in the comments, which we'll read here. It's fun. This is why I like the comments and I enjoy them because a lot of people say I turn the comments off or I don't read the comments. That's what Joe Rogan says and stuff. I enjoy the comments. First, I learn a lot. Believe it or not, I learn a lot from the comments. Secondly, people can disagree. I don't care, and they can call me names. It literally does not matter to me. Maybe you have to have thick skin in this game. I don't even think you have to have thick skin. You just got to say, frankly, once you realize that there are two primary commenters, one are bots, and then two are people who haven't watched the video. And I've seen that a million times. People comment and they don't watch the video. And that's the most frustrating thing because you're like, dude, you're attributing things I didn't say. And the only reason you say that is because you didn't watch the video. And in this case, I can almost assure you this guy didn't watch the video. And that's okay. That's okay. People have a right to comment, but it's fun to look at them because it's engagement. Engagement's always good in the YouTube algorithm. But I enjoy the little bit of a tussle because it creates it is fun because these people are just simply dead wrong, and it's fun to be able to disprove them. Secondly, I've been in this business for so long that when people start commenting just idiotically, I know. I guess experience leads to confidence. There's no other way around that. And I've been doing this for so long. I've seen all the arguments. But every now and again, there's an argument that comes, that I have yet to, like the MMT, the modern monetary theory from Stephanie Kelton. And I have that will take you by, you're like, oh, okay, look at that. And then you got to think it through. And that's fun. That's learning. That's learning. That's growing. You'll hear arguments on occasion that you got to kind of reconsider. And I enjoy that very much. These kind of things are just ad hominem diatribes, and it's still fun because unfortunately there are people who agree with them. So here's this guy Vincent DS, and I'm not sure who Vincent DS is. Don't care, but he took me this again from May 2021. He said this guy, you talk about your old buddy Josh, is as dumb as he is inarticulate. Why do you call me dumb? It is hard to understand what he's saying because of all of his diversions and asides. And I every now I'll get that all the time, like that. You got to focus. Look, it's not my personality, man. My personality's all over the place. That's okay. It's just the idea. You got to change your way you do your videos so I can get better. You can appeal to me. I literally could care less. Merriman suggests a tilt to small cap value. Oh, so let me re-go what the thing with Merriman was. Merriman's argument is that small cap value will outperform. And he uses that based on historical numbers. So Merriman has blended and small cap value. Large, blended, and large cap value. I don't know if he still does. I don't follow Paul Merriman that much. And frankly, I don't like to go after punch up. So a lot of small YouTubers will punch up. They'll say, Josh Scanlon's wrong because of this. And then I'll punch up. I'll say Paul Merriman or Dave Ramsey is wrong because of that. It's a way to, there's a terminology they use for it, but I don't like that stuff. I mean, I do it I just don't do it that much. But a lot of people do that. And I always found that to be not a good way to grow your channel organically. If you want a quick hit, you can do that. So I can't believe Paul Merriman says this. You'll get people who follow because they say, what is he saying about my man Paul Merriman? And you'll get detractors and you'll get some people just because you're using someone else's name to grow your channel. I don't like to put my flag on another guy's ship. I mean, on occasion I'll do it when I see something preposterous, which is what Paul Merriman did here. But in of itself, I'm not against Paul Merriman for heaven's sake or Dave Ramsey. I just think there are some areas that they're wrong. How dare I? All right. So anyway, so Merriman's argument is against the value. You tilt to small cap value. So he's basically being redundant in his diversification. He has a blend, which consists of value, and then he has a tilt to value, small cap value in particular. And I'm going to share with you why this is wrong. Anyway, so he says, Merriman is just repeating the research done by Fama and French. And this is the appeal to authority that I hate to say it, but just idiots use all the time. I'm sorry. if you're going to appeal to authority, it's an idiotic argument to make. And this, I hate to say it, just to be, it's embarrassingly dumb to do this. It really is. But they're going to do it, and I'm going to show you why they do it even more. And I find it to be just frighteningly a cop-out, frankly. All right. See, he does the research by family and French. Merriman has also emphasized a diversified portfolio with a tilt to value and small cap in particular, which I talked about 100% in the videos. And then my argument, again, in the videos is going back to Jeremy Siegel, who actually done the research on small cap value to show you why this is a mistake to have a tilt to small cap value based on historical rates of return. I'm sure this is probably the fifth time I've shown you guys this, but I've done over 5,500 videos, so I don't expect everyone to have seen them. So we're going to read from Jeremy Siegel's Stocks of the Long Term. And, I take issue with the premise that stocks are safer in the long term, which is kind of like the Siegel model. Because to quote CCR and John Fogerty, someday, i.e. the long term, never comes. We're always in the short term. All right, so anyway, so we're going to go to page 177, and this is the third edition, the fifth edition. I got a couple of these editions on this. I can't remember. This from 2009 or 10 or something like that. Anyway, so let's read this. Trends in small cap returns. Although the historical returns of small cap stocks has outpaced large cap stocks since 1926, so that's the basis of Merriman and other small cap value acolytes, the magnitude of the small cap outperformance has waxed and waned unpredictably over the last 86 years. A comparison of the cumulative returns on small cap stocks with those of the S&P 500 is shown, and basically I'm going to read you that because to show it on the book would be a kind of a pain in the butt. Small caps, measured by the bottom quintile of market capitalization, that's small caps, recovered smartly from their beating during the Great Depression. But their performance only matched that of large stocks from 1926 to 1960. So small caps just were on par with large caps from 1926 to 1960. Even by the end of 1974, the average compounded return on small caps exceeded that of large caps by only 0.5% a year, 50 basis points. That's it. All right? Not nearly enough to compensate for the extra risk in trading cost. So factoring the risk, because small cap stocks are inherently more aggressive, more risky, and the trading cost, because small cap stocks don't have the volume of trading, the risk and the cost dwarfed the 50 basis points improvement in returns. And that's just a fact. And that's from 1926 to 1974. But between 1975 and 1983, small cap stocks exploded. During these years, small cap stocks averaged 35% a year, more than double the 15% compounded annual return of large stocks. Cumulative returns of small cap stocks during these 9 years were 1,400%. Nevertheless, this figure shows that the 9-year period from 1975 to 1983 is eliminated. The total accumulation in large stocks over the entire period of relative to small stocks is virtually the same. What caused this tremendous period of growth in small caps over those 9 years? In the late 70s and early 80s, pension and institutional money managers found themselves attracted to small stocks following the collapse of the Nifty 50 large cap growth stocks. In addition, the enactment of the ERISA, Employee Retirement Income Security Act by Congress in 1974 made it far easier for pension funds to diversify into small stocks, boosting their holdings. After 1983, though, small stocks hit a 17-year dry period as they underperformed large stocks, especially in the late 90s. Isn't that interesting? So basically, we have up and down of small relative to large, and then if we look at value, it's, let's just read. The second dimension of which stocks are, he just talks about valuation. But anyway, so you can see that value is more risky. That's why it's value, because the price is lower relative to earnings and relative to the price to book. And that's why the dividend yield is higher, because the price is down. It's riskier in value. That is a fact. This is not disputable. Anyway, so what happened with the small cap stocks is similar when they got rid of the ceiling on gold. It just exploded. All of a sudden, pension funds could go into small caps as a diversification mechanism, where before they really couldn't. Kind of like when they got rid of remember, it's illegal to buy gold. So everyone says, look at gold, it matches inflation, whatever they say, because it was completely held down under FDR all the way up to Nixon. So the 70s, when they got rid of the cap on gold, the ceiling, the artificial ceiling, it just exploded. And now, ever since, it's just been kind of, pittance. I mean, it's been good, bad, otherwise, but it's not a bad investment. But you shouldn't look at gold investing based on the 1970s, so because there was an artificial cap. Same thing with small caps. All right. So this is not debatable. And you can go small cap value. I fell for it. I did. Trust me. I said, small caps give you better performance than large caps. Small cap value gives you better performance than small cap growth. Thus, I'm going to put my weight to small cap value. And I had the Penn Pennsylvania Mutual Fund. I had the Penn Microcap Fund, other small cap value stock funds. And I said, and then I learned. I just read. I learned. So, okay, well, it doesn't make sense. Let's be diversified across the realm. All right, so then this guy calls me dumb and inarticulate. All right, whatever, man. Let's see here. And I said to that guy, this guy's representative of Paul Merriman's followers. Well, nothing really more needs to be said. And this guy said, I've been following Paul Merriman for years. His advice is nothing novel. It is straight from Fama and French. Because academics. Paul is an original. And look, right here. He just relies on Fama and French, who have a Nobel Prize, and has long championed the use of low-cost dimensional DFA. It's the Nobel Prize. Oh, the Nobel Prize. Okay. What's that, a Nobel Prize? When Genius Failed, the Rise and Fall of Long-Term Capital Management. It was founded in 1993, and it boasted a partnership which included not one but two Nobel Prize winners, and a cadre of Wall Street's academic and elite traders. But after 4 years, a $100 billion money-making juggernaut, it suddenly suffered catastrophic losses that jeopardized not only the biggest banks on Wall Street, but the stability of the financial system itself. Now, who were the Nobel Prize winners that were attached to LTC? One was Nobel Prize winner Myron Scholes, or Scholes. You might know him from, though regarded as less of a heavyweight by other academics, Scholes was better known on Wall Street for the founding of the Black-Scholes model on options. Interesting. So not only did we have Myron Scholes, we also had Merton. Let's see if we can't find Merton here, because it's actually pretty funny. Right here. Harvard's Robert C. Merton was a leading scholar in finance, considered by many as a genius in his field. He had trained several generations of Wall Street traders. Let's see. Merton was the son of a prominent Columbia University social scientist who had studied the behavior of scientists. All right, so the younger Merton, who grew up in Hastings-on-the-Hudson outside New York City, showed a knack for devising systematic approaches to whatever he tackled. He was very eager. In fact, in the early 1970s, he tackled a problem that was partially solved by two other economists, Fisher Black and Myron Scholes. Isn't that interesting? So the whole point was we have a cadre of academics, PhDs, Nobel Prize winners, and yet it still failed. So anytime I hear, French Fama have a Nobel Prize, I'm like, okay. And then we say, check this out. Let's see. This is typical. I am inconsistent, flippant, sarcastic, bullheaded, and sometimes wrong. Okay, whatever. I remember whenever you recommend a view, always invest in the S&P 500. You build a mention. Okay, whatever. There's always value somewhere in the market. It's not always going to be in large cap. All right, whatever. I don't care. Let's see. Right here. People hate being poor with facts. Right here. There is some validity about using 10% rates of return projections like Ramsey refers to. Yes, it's a valid point, but past results are no guarantee of future performance. I use 6.5% right here. Index portfolio, similar to what Merriman suggests. Anyway, I'd rather face the issue of having way more than projected than way less at the finish line. Okay, that's whatever you got to do, man. Right here, my man, Vanguard Values. All you need is total stock. All you need, 100%. I don't use projected returns either. My portfolio of Vanguard is 80% value and 20% growth because small cap value is somewhat overrepresented. Exactly, because you've been following Paul Merriman, and Paul Merriman is wrong there. It has probably underperformed during the last 10 years because of the emphasis on value. However, still tripled. Thanks to people like Fama French, Mark Hebner, and Paul Merriman. But here we go right here. My man Sylvan kills him. Fama and French, who invented the three-factor model, which is where I cut my teeth reading the three-factor model by Fama and French. That's the three-factor model of value, small cap value. That's where I cut my teeth. In 1994, I think is when I read that book or maybe it's an article my economics professor George Mason gave me. Oops, make that four-factor. Oh, wait, five-factor, or maybe now a dividend factor. It's always back testing based on cherry-picking data. Yep. And if your actions aren't based on, this is the issue with dimensional fund advisors and all these people. If your actions aren't based on evidence, what good is it? They're evidence-based investing. I so despise that terminology. The discovery of COVID vaccine was based on, there we go. Well, I didn't read that part of it. Oh my goodness, discovery of COVID vaccine was based on evidence and data. Like these people just love their academics. It's crazy. It's crazy. I'll trust the academic professionals who are more likely to be impartial before I trust Wall Street professionals who are trying to sell you something. I literally cannot believe the level of ignorance in this guy. Who is attached to DFA? How do you not know this? How do you not know DFA, French and Fama? Then we go to creative planning with Jonathan Clemens. How do you not know that? That they're impartial? Are you? Then my man says, Sylvan, based on complete academic irrelevance of French and Fama, there are only three possibilities. You don't understand them? Yep. You are also an academic, or you don't understand between the difference between academic theory and real-world practice. Do you understand the complete nonsense of efficient market hypothesis? I didn't see all this by Sylvan. I could not agree more. The EMSH is so freaking stupid. I just want to jump off a bridge head first. Oh, it's nuts. Do you understand the meaningless definition of risk in academia? How do you replace that definition of risk in the real world and still simplify enough to utilize French and Fama and all of NPT with Markowitz? Completely agree. Well, Dimensional Fund Advisors is an investment firm with $700 billion in assets, founded on the principles of French and Fama. Three-factor, now it's five-factor with a dividend. I would call that the real world. My takeaway is efficient markets is that market timing is fluid exercise. That's not efficient market. I'll continue to invest in low-cost passive funds. At any rate, even the markets aren't completely efficient. So basically, Sylvan has run this guy up the flagpole, and the guy doesn't know when to stop. In other words, the academics prey on vulnerable people to rake in investment fees. Now, watch what he says. How can academics prey on vulnerable people to rake in investment fees since they aren't registered investment advisors? Because they're consultants. What does it matter if a French and Fama get a W-2 income or consulting income or royalty income? Investment fees pay all of them via Dimensional Fund Advisors, which charges people 1% a year. Oh my, it's so freaking frustrating. I literally cannot, but this is typical of the credentialed elite. I don't know who, I don't know, does this guy even got a YouTube channel? I literally sit there and I'm in awe at how good the credentialed. Let's see. He follows the nude blogger. Oh boy. He follows the Republican Accountability. So he massive man. Lucia Capital Group. Is that Ray Lucia? Secrets of Histoire. I don't know. Whatever. I can't. Look, there's no other way around it. You're going to have the academic credentialed who are going to tell people like this. He probably reads The Economist. He probably reads, I hate to even say the New York Times because, basically we all know the New York Times is silly now. Even the left knows that. But The Economist, I'm trying to think what else. Some other, basically quasi-scientific economic, barons, I guess. I don't even know what. It's embarrassing, my friends. Don't come at me with your freaking Nobel Prize crap. It has no value here. None. Don't come at me with your dimensional fund advisors, evidence-based investing. It has no value here. None. Going back to what one guy said, buy the index and be done with it. Now, you don't have to. I don't care. But don't sit there and call me names because you don't understand the theory that goes into this stuff. And just because the credentialed masses say it means this works, or that because DFA has $700 billion in assets. All right. Anyway, there you go. I love taking on the haters because the haters have nothing. Nothing. I'm surprised my man Sylvan was able to just quickly disabuse this guy of his rationale because it makes no sense. You can be value oriented. Absolutely. In fact, the funny thing is another guy said here, hold on a sec. Someone here said that obviously I don't believe in value stocks. I can't remember what it says. Of course I do because I was heavy into VTV, and I'm heavy into Wellington now. It's my biggest holding by far. I completely believe in value stocks, 100%. The issue isn't to say I'm diversified in a blend portfolio and then to over-diversify to redundant in a value portfolio. That doesn't make sense. You're doubling up on the value side, which means you have a tilt. I get that. I got no qualm with that. But then to turn around and extrapolate that to say that will perform better because of historical things is freaking silly. The reason I am heavy into value is because I believe in dividend stocks. I have no clue if they're going to outperform. Dividend stocks will give me the cash flow in order to build more shares and ultimately to live on it. That's why I am value tilted. They're more aggressive. There's more risk in value stocks. That is a fact, Jack. However, I believe value stocks are the way to go. Dividends pay dividends. Literally, they pay dividends. Small cap value as a over tilt on the value side makes no sense to me if the reasoning for your small cap value is a period of 8 years from 1977 to 1983. I don't buy that for 2 seconds, and especially if you're going to turn around and say that will give you a better return. Why do I do it? Because it's safer for me. It's safer, in my opinion. Dividend stocks are safer in the long run, in my opinion. Why? Because the dividends pay cash. Cash you can use to buy more shares. Cash you can use to take. If the dividends ever stop, a la 2007 and 8, you're going to be in a world of hurt. And right now, I am market timing without question, and I have a value tilt even more because the growth stocks did just like the value stocks versus growth in the 1990s. Growth stocks outperform, value is going to come back. The point being is to use the value stock, small cap value, and say you need to be heavy here, and we should expect a higher rate of return. I just find that to be fanciful. Anyway, that's my thought. And we got a lot of Paul Merriman people on here just bashing your old buddy Josh. That's cool. I got no problem with that. Do what you got to do. But just don't use numbers from a 6-year time. It's like saying gold's going to outperform because in 1977, 1974 to 1981, gold did better. Oh, it's embarrassing. All right. We'll see ya.